All right, welcome back. So this week we're going to talk about syndication. What is a syndication and how does that apply to real estate investing? So real estate syndication is an investment where investors pool their money and resources to buy a larger property that they can afford on their own. You know, we can typically go out and maybe buy a fourplex on 8-unit or something like that by ourselves, or maybe with a couple of partners in a joint venture. But if you want to go out and own a 200-unit apartment building, that is a lot harder for an individual to go and do. So syndication solves that problem by allowing people to pool their money into a larger deal. And the syndication have like two kind of groups of people in there. There's the active investors, what we call the general partners, and passive investors, the limited partners. The general partners are the people that do all the work, whereas the limited partners are the one that bring the capital to the deal. I'm going to talk more about them in some future slides. A syndication has a stated business plan and typically a defined time period. So the business plan may be, renovate the units to raise rents and do other improvements to the property to make it more profitable. And then typically, the deal will be exited in anywhere from 3 to 10 years, depending on the business model and the plan that you're trying to execute. And it's a great way to get involved in multifamily investing without going out and doing all the work yourself. So a busy professional may choose to invest passively in a syndication to get the benefit of real estate investing. So the general partners are the sponsors of the deal, also sometimes called key principals. They do all the work and they bring their expertise and experience to the deal. They find a property through connecting with brokers, they underwrite it, they do all the due diligence on it, get the loan, and also, after the property is closed, they operate the property in the best interest of everyone involved. And they are compensated through their work through acquisition fees, typically, anywhere from 1 to 3% of the purchase price, asset management fees, and a split of the profits. So typically a syndication, you want the limited partner and the general partner's interests to be aligned through splits of the profit and so forth. The limited partners, LPs, they bring equity to the deal. Equity, i.e., the down payment and any kind of operating funds that are required to operate a deal. They don't participate in the daily operation of the deal. They trust and do their due diligence on the operator to make sure that they are actually know what they're doing and will operate a property in the best interest of everybody involved. And they're relying on the experience and track records of the GP to generate return on their investment. Limited partners typically don't have any liability beyond their initial investment. So if there's a slip and fall, any kind of lawsuit against the property, the limited partners are protected through the legal arrangements there. So the typical return on an investment, obviously varies depending on where the deal is and what type of setup it has. But typically an LP start out with a 7 to 9% cash-on-cash return on the investment. So, if you invest $100,000, the first year you may see anywhere from $7,000 to $9,000 or $10,000 on your investment. And this return can either be a straight split between the limited partners and the general partners, say, 70-30%, 70-30 split. So 70% of all the profits go to the limited partners and 30% goes to the general partners. Or it can be a preferred return that must be met before the GP earns a return. So sometimes you'll see a 7 or 8% preferred return, which is something that needs to be paid before any splits go to the GPs. When the property is either sold or refinanced, the limited partners and the general partners split the profits based on the structure. That could be 70-30, it could be all kinds of other deals. It really depends on how the deal looks and what the underwriting shows that the split should be. And most syndication, they model out an internal rate of return of 14 to 17% over hold time and try to double or triple the investor's money. So say the 5-year hold time, you invest $100,000, you can then expect or hope to get probably $200,000 in return over that period of time, and that would be your monthly cash flow and also any gains on the sale of the property. So this is a little bit technical here, but kind of going into rules and regulations around a syndication. A syndication is essentially a security. So by like you buying stocks in a company. However, you don't go through and do a public offering because that's very expensive and takes a long time. And for a $10 or $20 million deal, that doesn't make sense because of the cost of time involved. So the SEC, the Securities and Exchange Commission, have various exemptions you can follow as a syndicator to avoid having to do an actual register the security. And it's something that's called Regulation D, 506B, or 506C are the typical ones used for multifamily syndications. These exemptions allow sophisticated or accredited investors to invest in a syndication as long as they're aware of the risk involved and sign extensive amount of legal paperwork. And a syndication, so a sophisticated investor is somebody that understands the risk of real estate investing, but haven't reached certain financial thresholds. And they can invest in a 506B up to 35 sophisticated investors can be invested in a 506B syndication. And an accredited investor is somebody who owns either $200,000 a year individually or $300,000 with their spouse, and has a net worth over $1 million excluding their primary residence. Accredited investors can invest in both 506B and 506C. The 506C can only take accredited investors, and it has to be verified by, providing financial statements or through some third party or CPA. So those are more strict, but it does allow for advertising. And here's another thing I didn't mention or didn't put in my slide here is that you can't advertise a 506B, so you have to have a pre-existing or an existing relationship with your investors. Although on a 506C you can advertise, but you can only take accredited investors in that deal. As always, anybody who wants to get on a call with me, then go to opendoorscapital.com/call, and I'll be happy to talk to you. Next week, I'm going to talk about something called a self-directed IRA that allows you to use your retirement funds to invest in real estate. Until then, let me know if you have any questions. Jens at opendoorscapital.com. You can go to my website, opendoorscapital.com. Thank you so much.